let's talk a little bit about how we trade the financial market. This is really how we approach things. Basically, we could take any market, it doesn't matter what it is, whether it's a currency or a commodity, or whether it's a stock, and we can break it down into one of two categories. It's either going to be choppy, going sideways, all right, or it's going to be trending. So it could be trending to the upside, or it could be trending to the downside. Generally, it'll be one of these two things. Now, the actual nature of a market that is going sideways is very different from when it is trending. It's two different states of mind. It's like one's asleep, one's awake. They're just not the same kind of market conditions. They're not the same kind of animals. And we need to understand that. It doesn't matter whether we're looking at Apple and it's going sideways or Apple and it's trending. It's still not the same when it's going sideways versus when it's trending. So as a general rule, the problem with when a market is going sideways is that it doesn't matter whether we buy or sell, the market can behave erratically. It can just keep bobbing around, and it can be very painful. And so as a starting point, we should just eliminate engaging in a market that is going sideways. Just stay away from it. And just stay away from it. And we will find that actually we will have fewer losing trades, because in a market like this, we will have lots and lots of losing trades and give a lot of money back to the markets. It'll be very stressful, very painful, and financially it'll cost us. But if we eliminate that, and when we start to look at charts that are only trending down or trending up, we then are already positioning ourselves we're in a better place. We already are on the right foot, because in a trending market, if we then look to position ourselves to go in the same direction as that trend, we are more likely to make money, much more likely to make money than to lose money. So that's a starting concept. So then this is where it gets kind of cool, is okay, so we need a strategy. So how does the strategy work? So what we've done so far is we have agreed that we're only going to focus on trending markets. So the next thing we need to do is, okay, well, now that we have found a trending market, it gets really simple. That's 50% of the work done. Why? Well, because we found a market, we know which one to trade, and we know which direction to go in. That's 50% of the work done. What is left over is, where do we get in? Where do we get out, and where do we put our stop loss? Because obviously the market could change direction. I mean, there's only three directions it can go in. It can go up, down, or sideways, even if it's already trending up. What I mean by that is, if I decide to buy, the market can still go up, down, or sideways. It could change direction. It's possible. Of course it is. It's not likely, but it is possible. So what's left now is I need an entry, a stop loss, and a take profit. And it's really important that I know that there are rules for all three. An entry, when you're trading, you're not investing. So you need a very specific point where you need to get in to a pip. It's got to be very specific. You need to know where to put your stop loss, really precisely where that should be. And also there should be very hard and fast rules as to where you must take profits. You've got to take some profits. So when we're trending up like this, it's very interesting, because I'm going to clear this and start again from the bottom. We have this move in the direction of the trend: extension, retracement, extension, pullback, or push and pull. All right. So the worst time to try to join this trend is really in that second half. This little second half here is the worst time to get in. It's usually when people get in, because they're on the sidelines, they don't have any training, they don't have any confidence, so they want to see a lot of evidence that the market is going in a particular direction. So they wait and wait and wait, and it keeps going and keeps going, and then they decide to jump in. So now they've seen so much evidence that they decide to get in, and they usually get in too late. They often get in the last quarter or the last 10% of the move, and then the move comes back down. And at this point, they panic, because they go, well, as soon as I got in, the market started to head back down again. And so then they get out at a loss. And so this becomes an abusive cycle. The irony is, of course, that they're submitting themselves to the same abusive cycle over and over again. So what we want to do is, we really don't want to do that. The confidence that the market is going to go up should not be from this one single move here, but from the series of moves. This is a collective series of moves, like waves coming up on the beach and going back, and coming up and going back, which also tells us, is the tide going out or is the tide coming in? So we're not necessarily picking our direction from just a single move, but from the collective series of moves. That tells us that's where the market is generally flowing to. And so again, if we start with this, and I say this is interesting because although there are many ways we could trade the markets, there's not an unlimited number of ways to do it. There's not an unlimited ways to manage your stop loss. There aren't an unlimited number of ways to get into a market. There's just there just might be more than 5, but that doesn't mean there's necessarily 5,000. Right, and so what we do is that if this period is the worst time for us to get in onto a trend, it actually leaves pretty much any other time becomes somewhat acceptable. Now, what most traders like to do is to wait for price to start to come back, to start its correction or its retracement, and then start looking for an entry. So they will start at about this point looking for an entry depending on their strategy, and all traders of all strategies will fit somewhere within this area. As price is coming back, the perfect spot is, if you can identify it, is the exact turning point before price starts to work its way back up to the highs. And there is a typical route where if we break above the previous high, that would be considered acceptable as well. So as soon as we break above the old high, we could get in. So that actually means that this is the last acceptable point for us to join a trend. I hope this makes sense to you. And then price goes on. After that, it gets too risky. We're entering this period again. So basically, from when the market starts to, when we know for sure it's now starting to retrace, until the last point at which it crosses over that, all trend trading strategies will have an entry to get in. All of the entries will be somewhere between these 2 points, and usually they will look to get in here at the turning point, that swing low in an uptrend or the swing high in a downtrend. But this is the sweet spot if they could do that. But this is also very acceptable for many traders. Once you break to new high, they'll get in there. Now, where would we put our stop loss? Okay, so this is where we're going to look to get in. Where would we look to put our stop loss? Okay, so many traders who look to get in on the break of this will often put their stop loss below the low here. Because in their mind, if price breaks through and then comes back down and breaks this low, then this trend is finished. There's a point at which we know that the trend has come to an end, and that would be it. Some of the traders who get in here also like to do that. If they can get in on a candlestick, a single individual candlestick here, they could put the entry above the high and their stop loss below the low. And then in theory, they're already profitable. Even before they get to this old high, they're already grabbing some profits. So let's just recap where we are so far. We have found a market that contains money-making opportunities because it is trending. It is trending upwards. Therefore, we are looking to be buyers to go with that trend. Ladies and gentlemen, this is the lowest, the least risky, least stressful, highest probability, greatest potential profitable way of trading compared to any other way of trading. Reversion to the mean is terrible. It's very stressful. And I add stressful because stress, our emotional stress and our psychological stress, is a major component of our day-to-day trading capabilities. You cannot trade successfully if your headspace isn't right, if you're not neutral or happy. Anything other than that is a problem. So we must choose for us individually a path that is going to be where we can accept the amount of stress and the amount of probability of success and understand our strategy in the market conditions that we get. So when we choose a trending market, we know we should be trading with that trend in that direction. Now we just have to find a good entry. We now know that that entry is somewhere between the pullback and the break of the next high or the break of the next low. So if we have a trend to the downside, that will be our last entry into it. And the most ideal one for us would be on the turning point of the pullback. These are that's the best entry if we can get it, and this is the last acceptable entry if we need to. They're acceptable, both of them. And we're in the trend. That's our goal. So we need to know where to put our stop loss. We could put it below this swing low, and it is also acceptable to put it below the most recent swing low as well. Further than that seems a bit extreme to me. The most recent swing low is acceptable. The previous swing low, turning point, it's a really good idea to put it behind that structure. Okay, those are the two most sort of safest kind of places to take it, relatively speaking. Whether our entry is above this candlestick or whether it's above here, those are where we could place our stop losses. And we need to talk about where we would, take profit. So all of this stuff is very important and tied to what we're talking about today. The average, ladies and gentlemen, please hear me now, because we are not gambling here. So our goal is to go out every day and catch fish. That's what you're doing. We're fishing for profits. So we might get 2 small fish one day. We might get a big fish the next day. We want to go where there's a likelihood of catching fish, so to speak. I know this might be an analogy that you don't like or appreciate, but just go with it for now. And so we're going with a fish are, which is a nice trend. We're looking to catch in certain spots, which would be like eddies where the water slows down. So that all makes sense. And it depends. Some days we might not get any. Sometimes we might catch one and the line breaks or it gets off the hook and it goes back in the water. Some days it pulls the fishing rod in with it. So we've got to now go buy a new rod. So there's expenses, so on and so forth. So we've got a variety of things that can happen. But it's a repeatable action we're going to do every day. And it's not gambling. It's not gambling because we're not trying to get one big trade to make lots of money. That's absolutely insane to take that approach. So we know that if we just do this on a repeatable basis, 60% of our trades on average will make money. So 6 out of 10 trades will make money. We should be net profitable. And the trades that make money should make way more money, 2 or 3 times the profits that the losing trades cost us. So what does that mean? It means that if I get in, if I'm going to change the colors here, if my entry is here with my stop loss here, all right, then the average, I need you to hear what I'm about to say here, the average move that the market is likely to make is going to be the average big move that it is likely to make will often be, we call this 1R. So that is 1R, that's my risk, 1% risk or 0.1% risk, doesn't matter, 1R will be 3 times that. So it'll be 1R, 2R, 3R, call it that. So that distance will be 3 times our initial one. Okay, so 1R, 2R. That is the best, let me slow it down and repeat it. This distance here is the best average big move we can expect on a regular basis, statistically. They've done the maths, the experience, all of it. It's very rare that we will get more than 3 times this move on a regular basis. So my average move is going to be that. So if that is my 1R, I'm expecting it to go ideally 2 or 3 times that distance and get some profit. I might not every single time, but the trades that do that will be great. Could some of them go 4 times that or 5 times that? Yes, some of them could. They absolutely could. But it becomes unreasonable for me to expect the market to do that. The market will do what it's going to do. It's reasonable for me to say that it's reasonable to expect that it will do 3 to 1s often. But it doesn't owe me anything more than that. Sometimes I only get 2 to 1. Sometimes I only get 1 to 1. And because I only get 1 to 1, I like to take some profit off the table. So when the market has triggered me in here and it goes past my first target, I like to take some profit off the table, 50% off the table. And I have a final target up here. So some traders go, well, why don't I just use a trailing stop and then I'll capture all the profit? Well, first of all, the market is very rarely going to go more than 3 to 1 anyway. All right. In fact, the problem is that sometimes it's going to go up behind. If you have a trailing stop behind price, it'll go up 3 to 1. You will have that 3% profit in your accounts, but the trailing stop will never get that high. And then price will turn around, come back, and you'll get stopped out. Maybe you've captured 1% of that 3 to 1. So it's silly. Your stop loss is only there to protect your existing capital in your account. The take profit is there to help grow your account. So people who think that the trailing stop approach is the best way to trade because is actually driven by greed. They think that if they trail their stop, they'll capture all the moves that are out there. And actually, in reality, you don't. You capture way more profits if you put a profit target in and you trail your stop from the one side. So you're capturing it. So if the market jumps up, you're here to take profit. If it falls back, you can capture at least something with your trailing stop. So you need to have one on either side. And so what have we discussed so far? We've discussed the idea of finding the right type of markets, which is the first component in a strategy. Which market should I be trading? The trending ones. So if gold's not trending, then I shouldn't be trading gold. If euro dollar is not trending, I shouldn't be trading euro dollar. Very cool. So now if it's trending, I should be looking for an entry into it, and I should be waiting for either a pullback or a breakout above a new level. We've narrowed that down. So conceptually, there's actually a reason in what we're doing here. I haven't even spoken about a strategy, but the idea makes sense. I also know that if I put my entry there, my stop loss, where my stop loss could be, but I also know that that entry to my stop loss constitutes 1R, and I have to get at least 3 times that. The problem with having a wider stop loss like here, so if I have a wider stop loss here, is that now represents my 1R. So the first trade that I showed you down here, this was 1R, and it only has to go this far to get me 3% return. 1R now means it has to go I can't even draw the rest. It has to go a lot further. So the goal of every trader, ladies and gentlemen, is to get their entry and their stop loss places, locations, as close to each other as reasonably without introducing more risk. Without introducing more risk. If I put my entry and my stop loss together like this, they're going to get spiked. They're going to get tapped out. So usually we want them a certain distance away. I mean, the closest my entry and stop loss ever is on day trading on small trades is like 6 or 7 pips. That's the closest. They're usually somewhere between 15 and 45 pips. My entry to my stop loss. Okay. So we've spoken about the idea of a strategy. So we have a strategy, for example, that we use, which you may have heard of, called the trend flow, which waits for price to pull back. It has the 10 and 20 moving averages going like this, 10 and 20, and we notice that price is doing this amazing cyclical behavior. And we look for an entry close to the moving averages, in and around the moving averages. That is where we expect that price will turn around and carry on, if it's going to carry on, because it's done it in the past. Okay, price comes back. We look for little clues. In an uptrend, I like to see either a little indecision candle, I'm going to show you this on the charts, or a green candle, something like that, or a nice little wick, something like that that says the buyers are coming back in, put my entry above the high, stop loss below the low, and take profit as we go. Sometimes I do that with 2 orders. So on the CMC platform, I could have 2 orders where I have 0.5% risk on each order, both with the same entry, both with the same stop loss, but one order has a 1-to-1 target, so it'll close out automatically if I'm asleep or I'm away when it hits the target, and the other one will have a 3-to-1 target. And then I can trail, and once my first 1-to-1 order is closed out, so I bank that profit, then I will look to trail my stop loss. The other strategy that we have, which is pretty cool, is very, very similar. We have the moving averages coming along like this, and it looks ideally for a particular pattern to occur for a breakout. And you get instead of putting your stop loss here, you can usually get your stop loss out closer. So your 1R is nice and small and tight, and therefore your first take profit is nice and close. And so you get your entry above the breakout of that. And this is a phenomenally powerful strategy. So why do we risk 1%? So let's say we have a strategy that has a 60%, what's known as a 60% win ratio, okay? i.e., it wins 60 out of 100 trades. It might do more. That number can go up if you know if you're reading good quality trends, if you've got a nice, decent candle, all various things that will make the probabilities of success go really well. So it is called the 60% win ratio, which means that out of 10 trades, I will have 6 winning trades, I beg your pardon. So that's important. I've done, instead of doing 3-to-1, 3R, I've done 2.5R. I'm being very conservative here. So in this example, I'm assuming I've got good trends. Every single trade has got a good, strong trend. I assume I've got a decent candle, that my entry and my stop loss are nice, as close together as they can be without making it more risky. And the candles look good, the moving averages look good, support resistance, which are other factors in a strategy, make sense. So therefore, it's fair, it's not unreasonable for me to assume that at least 6 out of those 10 trades will be winning trades. But it's quite interesting, because as a beginner trader, I might make mistakes. So as a beginner trader, maybe I only get 2 trades correct because, I don't know, maybe I didn't look at the higher time frame. So maybe what's happening is the daily euro dollar, like it is now, is in a downtrend. And it's doing a correction before it goes down. So, but I don't realize this. On the 1 hour, I see an uptrend. So I'm looking at this little patch here. I see an uptrend. I decide to buy. As price gets to this point, I decide to buy. I expect it's going to go up. And actually, it starts doing this. Because why? Because the daily has started to head down again. So I happen to just, and this happens a lot, by the way, I would say easily 50% of the mistakes that you're making in all your major trades, if you're staying on the same strategy, is probably there's a difference between the direction you're trading on the lower time frame and the direction the market is going in on the higher time frame. That's a big chunk of why traders have losing trades. So that could be a reason why maybe this trader had a couple of wins and the rest were losses. But imagine this beginner trader now going, I've tried the strategy, I followed the rules as best I could, and I had 8 losses and 2 wins, and I'm down. So I've lost money, and I got punched in the stomach. I punched in the gut 8 times. So this is why, even if you have a good strategy that works, but maybe your eyes haven't adjusted to it yet, because it's a bit like hieroglyphics in the beginning. It's a bit like the market reading the charts and looking at the candlesticks and everything is a bit like very noisy and doesn't make sense. It takes practice and education to learn to read the hieroglyphics so that they start to make sense to us. And so this trader actually often would quit, even though they haven't done enough trades and had enough training to really make that decision. It's not an informed decision. And so I come in and I go, okay, well, my first rule is I take some profit off a 1-to-1. So suddenly I have 3 trades where I get some money out of them. Okay. And then I have a couple of trades where, because I take some money out, the market gives me some money and then stops me out, so I'm break even. So I have a couple where I get a little bit of money, 0.5% each, and I get another one where I don't make money, I don't lose money, but here it is. I've only had 3 losses now, and I'm up 3.5% profitable. And here's the amazing thing. I haven't actually had any more full wins than the beginner trader. So why am I showing you this, ladies and gentlemen? I'm trying to show you, first of all, that trade management can make the difference between a profitable account and not. Same trades, but just taking some money off the table reduces your losses. That's really what this will do. It will reduce my losses. I don't even necessarily have to have more winners. I just have fewer losses, and I don't give as much money back. So this is a trade management plan. It is a risk management plan as well. So where does the 1% traditional risk come from? Where does this come from? It has an amazing history, but it largely is established from professional poker playing, MIT research and mathematics, as well as just experienced traders. There's a thing called risk of ruin, which basically says if you imagine you're a poker player, right? So you're playing a game of poker, you're a good poker player, so you've got a great hand, but turns out that the other person on the other side of the table or somebody else after you has got a better hand. So you've got a great hand, they've got a better hand. So you could still lose even if what you're looking at is a good trade. The market direction can change after that, but it can be a good trade. In hindsight, you take the same trade over and over again. You take the same hand in poker, you play the same hand. Here's the problem, though. If you have a kitty of money next to you, and every time you think you're going to win, you put a lot of your kitty on the table because you are so confident you're going to win, even though you can't see the other person's cards, you could still lose. And if you have a series of those incidents, what do you think is going to happen to your self-confidence and your headspace? Are you going to become calm? Are you going to stay calm and cool and collected? Or are you going to become slowly but surely you're going to start to unwind? What if you borrowed the money off your credit card or borrowed off someone else or off your mortgage or off your pension? Do you think that you're going to be able to stay calm because now you've lost 60% of your pension? So not only do we become a bit unhinged when we lose money, we actually become less effective. I mean, it's hard enough bringing our A game every day, but it takes the smallest thing to set us off. And the only way to overcome that, ladies and gentlemen, first of all, is not to expose ourselves to that kind of pain. Therefore, we don't risk more than we can afford to lose in a single trade. And 2, learn to manage ourselves. Learn to not do that and expose ourselves and make sure we're in a situation where we're going to lose it. So they worked out mathematically that even if you were one of those poker players and you reduced the amount of money, maximum amounts of money you risked on each hand, even if you had a really weird day where you just had an unusual number of losses, and even if you became a bit emotionally unstable, you still wouldn't do so much damage to your account, to your kitty, that you couldn't rebuild it very quickly. When you finally just calmed down, you maybe walked away from the table, came back the next day, and you're like, okay, I'm fine now, I'm good, and then you made the money back. You could rebuild your account really quickly. And it's mathematics at this time, mathematics and probabilities and statistics. But as soon as we go to 2%, risk, that risk of ruin, in other words, that ability for us to destroy our account beyond repair, excuse me, increases. So at 1%, it's zero. At risking at 1% of your account, you can never destroy your account. It's impossible because you just keep getting smaller and smaller and smaller chips. But if you go to 3%, there's something like a 60% chance you can destroy your account. So if you have 10 losing trades in a row, you will do so much damage to your accounts. You may never be able to recover it. You might, or it'll take you so long to recover it. So we know from that and experience and wisdom and mathematics that 1% is the maximum we should risk. I risk 0.25% per trade sometimes, 0.25%, maybe even 0.5% regularly. This is fantastic. Let me tell you why. Because if I'm right, I get almost a whole percent out of a trade. So all I need is 2 or 3 of those in a day, and I'm up 1% plus for the day. So all I need to do, remember, is to do 2 to 5 trades per week to make 1% profit. So I can go to very, very tiny, minuscule amounts of risk per trade and still maybe make 1 to 2% in a week, which is very good. And I find for me, that is my safe space. My brain hardly takes a wobble. I was explaining to my better half the other day, I lost 3% in a day, and it freaked me out because that was the most I'd lost in a very, very long time. And I had to walk myself off a cliff as well. So it hasn't happened to me in a while, and it never goes away. You just work out what is your personal comfort zone and safe space for that. So this is why we talk about position sizing. That is how much we have to risk on our trade. This is why we talk about ideally taking a certain number of trades per day. And this is the same strategy. So you might be looking at this going, these are probabilities and numbers, and this is just how do I know that this is the case? This is all based on if I was trading a trend like I showed you on the other chart, and I was buying above a candle and my stop loss below the low, and I was taking profit at 1-to-1 and targeting at 3-to-1. I've described a strategy to you, and I'm going to tell you more about that. If I took that strategy and I applied this applies to that. Okay. So the question then is, well, when should I stop trading? And this is important. If and the 3% that I lost the previous week, by the way, was actually, it was a new account. It was a new account, and there was an issue with the position sizing, and it was more, there was risk that was supposed to be the case. So it wasn't multiple trades, and that's why I say I had to remind myself it wasn't due to, it was a technical bug and a mistake which shouldn't happen. But usually in this case, I'd be risking anywhere from 1/4 to 0.5% per trade. And I find for myself, I don't mind being up to 1 or 2% down for a day. That's okay. I can recover quickly. When I'm down 3 or 4% for the day, that is insane for me. And then I find that psychologically, I might have to stop trading for a few days to get myself back in the game. So I've worked out for myself at 1/4%, I could have 3 or 4 losing trades, and I haven't even lost 1% for the day.